Good morning, good evening, good afternoon, traders. Thank you so much again for joining us here at Trade Delicious. We're super excited to bring you some more educational content, some more fun, specifically on something that's very near and dear to my heart. Let's hop right into it. It's near and dear to my heart because it's the U.S. Crude Oil Inventories Report. This is a report that comes out weekly, and it's about my favorite product, crude oil. I'm an avid crude trader. I only trade three things on a daily basis, those being the S&P 500, the Nasdaq, and crude oil. And it's so much fun. This is one of the reasons why I trade it, because there's news about it every week and it's guaranteed to move markets. So let's get into it. What is the US Crude Oil Inventories Report? The Crude Oil Inventories Report, or the Weekly Petroleum Status Report, as referred to by the US EIA, measures the weekly change in the number of barrels of commercial crude oil held by U.S. firms. This is mostly focused on inventories in Cushing, Oklahoma. This is very close to where we hold our strategic inventories and where most inventories for major companies, Chevron, BP, etc., hold their oil. This report provides simply the weekly change of barrels of crude oil, usually on Wednesday of each week. This data, of course, as I said before, comes from the U.S. Energy Information Administration. So, some more details. What's included in this report? I'll be honest with you, it's not the sexiest thing in the world, right? You have words, and more words. The most important things we focus on are the weekly production numbers, the weekly changes in percentages, and then the basic analysis, right? The headline number is going to be the most important part of this conversation. The rest of this data, if we see an anomaly, we pay attention to it, but generally speaking, we don't see an anomaly. A good example of that would be something like the U.S. commercial crude inventories this week. This is the week of June 2nd, 2023. Went down 500,000 barrels, bringing the total inventories down 2% over 5 years. That's not a big number. No one cares about that. If that number is 12%, if that number is 20%, give me a call and then we can start having a conversation, right? Now remember, crude oil is a huge part of our economy. According to the American Institute of Petroleum, oil and natural gas represent approximately 8% of total GDP, and those two industries together hold about 10 million American jobs. It's a really big deal to the economy here in the States and really anywhere in the world where people are getting around with cars. Crude oil is so intrinsically connected to gas consumption, right? Of course, all gas comes from crude oil. All petroleum products are very, very, very interconnected to crude oil. Hence why it's so important, and hence why we trade it, and so many people are interested in it. The headline number. Let's get to the fun stuff, right? So the headline number is just the actual overage or shortage of oil barrels held at U.S. firms, right? A shortage is generally referred to as a draw, and overage is generally referred to as a build in inventories. It's simple, short, and sweet. You got the date that the thing came out, you got what the previous actual report was, and then you have the forecast and the actual report as it stands right now. And as you can see, we'll get into this a little bit later, the forecasts are generally off, and they're generally very off, which creates volatility and therefore opportunity for day traders. Let's keep going into this. How do you analyze it? As I was talking about before, it really depends on how off estimates are for short-term traders. Short-term traders being those that have a time frame that's less than a day. We're talking our traders are looking at maybe the 4 hour, maybe a little bit tighter than that, the 1 hour, the 15-minute, 5-minute, 1-minute charts. We care a little bit more about the volatility coming out of this kind of report. Long-term analysis really depends on current economic conditions. Then we could start having a conversation, right? Let's start off with the long-term analysis. Strong builds over several weeks may indicate a weakness in demand, for example, raising supply and building prices over time, and vice versa. We've seen a little bit of this as we have started discussing the issues with OPEC. We started discussing some of the issues with demand out of China. Prices have been falling considerably. So when we're talking about inventories potentially going up, prices generally speaking go down, and they generally speaking go down very aggressively. The opportunities here may appear to short crude oil futures or crude oil producers, right? So if inventories go up, we can see companies like Chevron, we can see companies like BP start to suffer in their stock exposure because all they do is produce crude oil and their profit margins are quite tight. Last year, BP did billions of dollars in sales, hundreds of billions of dollars. But if you look at their balance sheet, somehow they only brought in a profit of 1.4 billion. Only bought in a profit, right? But that's important to keep in mind. It's very, very, very expensive to refine, produce, and transport this oil around the globe. So falling oil prices hit companies very hard. It hits crude oil very, very, very hard in terms of all of the products that it's related to. From a short-term analysis perspective, forecasting for crude oil inventories is notoriously difficult, often meaning analysts are off, really off. As you can see, this is just a quick snapshot of what we've seen over the past few weeks. Some weeks it makes sense, some weeks analysts are pretty close. A good example would be, let's see here, April 12th. We saw a forecast of a shortage of 583,000 barrels. I must have to remind you that this M stands for million, so 0.5 million is 500,000, of course. We're expecting a draw of 0.58 million. We get a overage or a build of 0.59 million. That's not the end of the world. Negative 580,000 versus positive 590,000 isn't that crazy for crude oil. Now, we start to get a little crazy when we talk about a forecast of, say, 920,000 barrels being a draw, so negative inventories. We expect to see less inventories. And then the actual number prints at a negative 12.45 million barrels. Obviously, analysts were a little off that week, and it produced a little bit of volatility within the markets. What do I mean? Let me explain that a little bit. Forecasting errors of magnitude often result in high volatility in the short term, followed by a return to normalcy if there is little support for the catalyst. The catalyst being the news event. A lot of traders are able to take advantage of this news and try to use it as a further thesis to support their trades. Here's a quick chart that I pulled off of my charts from the date that we were talking about. So if we look back at what happened, it was in May 24th. This is May 24th, right at 10:30. You can see you have all of these small candles for the most part. Right at 10:30, we see a massive bullish engulfing candle in the 5-minute chart. It hits straight into resistance and then falls incredibly aggressively, and we continually traded this range for the rest of that day. But for that one bar, that one 5-minute bar, we saw a lot of motion. It was a really bullish sign that there was such an intense shortage. The more shortage you have in supply, the more demand remains the same, the more prices should go up, right? But the reality of it is, crude oil, like any other market, it's a technical market, and it's a very complicated market. So you cannot use one item as a catalyst to say a market should go up or down incredibly aggressively. It's one of the reasons why I wanted to choose this example, so that you can see that it does produce a lot of volatility, but it doesn't always produce sustained moves. Keep that in mind when you're ever looking at this kind of event. Always remember that commodities are super unique, as they're physical goods refined by either behemoth companies or state-run companies, meaning a rise in oil is great for some parties at any time. Let's think Saudi Arabia, let's think again Chevron and BP. Whereas for others, it could be a big hurdle. The U.S. presidents are often judged very intensely by how expensive gas was during their presidency, although U.S. presidents have very little control over what the gas price is. But it's a big part of what people perceive their jobs to be, and the facts do not matter. Perception matters considerably more. If inventories print bullish, for example, the perception is Because there's a shortage, we should see prices rise. So for Chevron and BP, crude oil futures, these products and stocks benefit from the perception. If the print is bearish and we see an overage, we see a build in inventories, then these same names may suffer because the perception is a higher supply equals less prices if demand remains the same. In 2023, a growth in any price, so let's say that something prints bullish, a growth in any price means inflation may rise. And of course, as we discussed numerous times on this channel, this year the Federal Reserve acts very aggressively when they see products getting out of hand in terms of price. They continual raise in something like oil may contribute to the Federal Reserve's decision to raise rates, which of course wouldn't be exciting from an economic perspective. That could stifle economies quite a bit, and that could cause us to slip into a slight recession. Always remember that these details, this report, is a part of a much larger whole. So never look at anything through a needle. Always look at the bird's eye view in order to get a complete understanding of a market, in this case, crude oil. That's all I got for you. Thank you so much, as always, for joining us. If you liked the video, please let us know down below in the comments. Please like, subscribe if you want some more information, and put on your notifications. We're live all the time talking about different opportunities in trading, different areas where we can grow as traders, as well as interviewing some of the best traders in the business so that you can learn how to be the best possible trader you can be. As always, I hope you have a magnificent rest of your day, night, afternoon, whenever you're watching this, and whatever part of this beautiful planet you're watching this. I hope you trade well today, and I hope you trade delicious. I'll see you.